CIO Jill will now take us through both one, Jill, maybe commentary as to why we chose to underwrite these markets, select these markets, and now form the fund around these three markets in partnership with Trilogy. And then I know you've been very active in communicating with Senator Tim Scott's office, so I think you've got the real time on the possibility of extensions and expansion of the Opportunity Zone legislation.
Great. Thanks, Jeff. So would like to just make really 3 points first before jumping into that to discussion about opportunity zones. Point one is really why these locations and something at Pinnacle Partners where we focus heavily on what are the major economic drivers in the market. And I think that's a point that really Austin, I think, hit home with his discussion is you have in the Atlanta market, you have significant Fortune 100 company locations, excellent college towns. So you have just significant economic drivers of why Atlanta, why Decatur. Secondly, with Augusta, you have Fort Eisenhower, 31,000 employees. We can all of us really see significant investment being done in cybersecurity. We know why it's important. And so that's a big economic driver for our project in Augusta. And then thirdly, you have the story of Huntsville. Have been looking at that market, investing in that market for myself personally for over 5 years. And you have, with the Redstone Arsenal, 38,000 employees, with Cummings Research Park, Jeff Bezos's rocket companies headquartered there as another example, over 20,000 employees. So just a story of a growing economy. So that's the first point. The second is, lots of projects and lots of funds talk about their projects being permit ready and, or shovel ready. And what I'd like to just say is, these projects are truly shovel and permit ready. These projects are either capitalized or imminently with debt, line of sight into debt. And so these are truly strong locations, strong markets, shovel ready projects. And just wanted to make a point, and this is something that I encourage you to check out our war room, follow up with Jeff and his team. So this is a fund that we're co-sponsoring with Trilogy. And it's something where we are, in terms of our fee load and the fees that our investors would pay, we've moved to just one layer of fees that we're sharing in a co-sponsorship function with Trilogy. And so as a result, we're able to pass those savings on to our investors. And it's a point that we'd really love to talk with you more about how it works, but just wanted to point it out is that this is a very unique offering to have just one layer of fees plus have three identified deals. So not a blind fund, three identified deals that are shovel ready in strong locations. And then, moving into opportunity zones. So this, all of these projects, this fund would qualify for the opportunity zone benefits. And as we look in the future, the questions, what do opportunity zones, what does this tax program look like in this new administration? And so fortunately, as you may know, that President Trump on the campaign trail made opportunity zones a key part of his campaigning. He even mentioned it at his acceptance for the Republican nomination, gave a shout out to opportunity zones. And so what I'd first start out with is we have allies, opportunity zone allies in key roles in the administration and in Congress. And so I'll just mention those allies and then talk about why that's important. And so that those allies, just for example, include Senator Tim Scott, who's now chair on the Senate side of the Senate Banking Committee. You have Congressman Smith from Missouri, who is chair of the Ways and Means Committee. And you now have the former executive director of the White House Council on Opportunity and Revitalization, Scott Turner. He is now the new HUD secretary. So he was in the role of advocating and coordinating the government efforts around Opportunity Zone in the past Trump administration. So now he's Secretary Turner and playing a key role. We have Opportunity Zone allies really throughout government, whether that's in Treasury, all the way to, education, ag, all through the government. And so it really paints a very favorable story as it relates to the administration. And then also you look at Congress and having key opportunity zone allies in Congress. What I also point out is some folks may not be aware of this, but in its DNA, the OZ tax incentive was bipartisan. So it was bipartisan in the House, it was bipartisan in the Senate. And interestingly, in 2020, Joe Biden made opportunity zones a key part of his economic plan, and he kept opportunity zones and some of the provisions that have been passed in the White House Council in place. My point is that this isn't just about, Republican and a new administration and having key people in Congress. It's also something on the other side of the aisle. There are key Democratic allies that see the positive that has taken place. So why it's important is there's three potential avenues for changes to this tax incentive. The first is a tax bill. And what you may have seen this week is President Trump came out in support of one bill. So there was discussion on the Senate side of having a tax bill plus a bill that included everything else, border security, energy. So he's in support of one bill. And what we're facing is the Tax Cut and Jobs Act in 2017, which Opportunity Zones was a part. Key provisions of it are expiring, as well as the Opportunity Zone tax incentive is expiring for new investments. So if you have an investment you've already made, you're fine. But if you would like to make an investment, you have until the end of 2026, tax year 2026, to make an investment. And so it requires an act of Congress to renew. And that's something that we can talk about what that might look like. And so that's why it's important to have key allies in Congress. There's also opportunities with a new administration, with new people serving that are Opportunity Zone allies. There's opportunities for the regulations to change. And so there's some technical aspects of the regulations that could improve. It can make your tax attorneys and your accountants very happy to just have this kind of function and fit together better. So there's opportunities for that. And there's also an opportunity for an executive order. In the 2016 White House, Trump set up and passed an executive order that established this White House Council essentially for opportunity zones to really bring together all of government in support of opportunity zones. So there's another chance for an executive order. Will that happen? I don't know, but it could be very, very interesting to see what that might look like. As I mentioned, for a potential extension, there's also conversations and advocates lobbying and speaking about, let's not just extend this, let's make this permanent, where it really functions as almost like a rolling program. So and I'll get into some of the suggestions from Novogradac, a tax and accounting firm. They have a working group that they've submitted a letter to Treasury and a letter to key stakeholders to advocate for changes to the program that Congress can take up. And one thing that we've really seen at Pinnacle, as I'm sure other folks may have experienced, is that interest in opportunity zones really tracks and correlates with the equities market. So when we see our NVIDIA stock going up or Apple stock hitting a high, folks decide to sell and put some investments into opportunity zones. And so as we have the stock market returning and starting to return and increase, we also expect there to be more interest in the tax incentive. And in terms of just the impact to date, the data from the government, the latest data the government has is the end of 2022. And there's been over close to 85 billion in equity invested with the tax incentive. And as you know, there's 2+ years beyond that. So, we can extrapolate what beyond the 85 billion in equity may be invested. And I would suggest that 85 billion is, if not at 100, it's approaching 100 billion in equity. And so to touch on Novogradac's Opportunity Zone working group letter, these are several recommendations that they made and other folks advocating for changes in legislation and for changes for this tax incentive. So, think about this as maybe an Opportunity Zones 2.0. As I mentioned, extending the deadline or making this tax incentive permanent. The other is enhancing reporting to make the data more transparent. So where these investments are taking place, helping the policymakers really understand how this money and where this money is being spent. There's limited reporting that's being done to really people report that they made an investment and these funds say, how much they invested and what census tract or where they invested. But beyond that, there's not really a lot of data. And so a lot of the analysis that's been done is really extrapolating that information and doing analysis around public, information that the request from the IRS. So just having this available that policymakers can get real time will really help with tweaking or improving this tax incentive. As we know, or maybe you're not quite familiar, but right now, a fund cannot invest in another fund. And if we enable a fund of funds model, this will really help expedite and also I think help expedite the aggregating of capital. And I think it would also open it up to more investors. And so investors that might want to invest with their capital gains, but might not have a place to invest because the funds have higher minimums. So this could help with that. One of the concerns is a lot of these investments have taken place in urban or suburban areas and really trying to, with an OZ 2.0, having and promoting more investments in rural communities. And in fact, that's what Chairman Smith had introduced in a previous Congress, a bill to expand opportunity zones in rural communities. And so there's really a strong desire to make this work in or better in rural communities, and also to really have this work better for our small businesses and operating businesses. And just another point I'd make about recommendations is to allow non-capital gain investments to receive tax benefits. And this was originally conceived of notion that there's billions or trillions invested in equities and, locked up in the market, and incentivizing that capital to move out of that market and into areas in need. So really attracting that capital into these underserved areas. But as a result, you just have really these intermittent types of capitals that are available, and it makes really bringing the money, which is the policy goal, bringing capital to these areas, it becomes very challenging. And so why not make this eligible for non-capital gain dollars if the goal is to bring private capital, and not the government capital, but private capital to areas that these governors have designated as, the most distressed and urgent areas in need of capital. And so that's the idea behind extending that. In addition, as I mentioned, there's regulatory recommendations. So my hope would be within the administration that the IRS takes up some of these regulatory questions and just makes it work and fit and answer some of these open questions that our tax attorneys and our accountants have, and just make it maybe it's cheaper for us to invest and to execute.
So thank you, Jill.